technical analysis. Big scary word, isn't it? Well, it really doesn't have to be. Technical analysis is the study of the price movement on a financial chart. Now, I explain technical analysis in an easier term. I call it chart analysis. It's anything and everything we do on a price chart. Whether you're just simply looking at a bare bones line chart, you're conducting technical analysis. If you're looking at a complex chart with candlesticks and MACD and RSI and stochastics and exponential moving averages, you're doing technical analysis. So we can think of technical analysis as a sort of framework that traders use to study and make use of price movements of the market. Now, technical analysis can also be very simple. And tonight I'm going to show you some of my charts that I work with, and you'll see I use very, very simple explanations, very simple pieces of technical data to understand what is happening in the markets. Now, technical analysis focuses exclusively on the study of price charts and trading history to determine future price movements. So again, I call technical analysis chart analysis. Technical analysis is anything you do on a price chart. So the primary reason that traders, whether you're going to be trading by, trading CFDs, or you're going to be trading by buying Bitcoin or selling Bitcoin or buying, Ethereum, okay, and holding it, is all the same. You're looking to determine where an asset might be going, where it's coming from, and whether it's trending up or down, and where you should get in the market and where you should get out of. And all this is based on past price movement. Now, technical analysts believe that all current market variables are reflected via the price movement or price action on a chart. So if we believe that all market variables are reflected via price movement, it only goes to reason that we don't really need much else to analyze and trade the markets besides price. Now you have to remember, with technical analysis, we're dealing with price movements, where the price has, what the historic price has been, where it's going, what the momentum is, what the volume is, what the volatility is. For cryptocurrency, whether you're trading an altcoin or you're trading Bitcoin, doesn't make a difference. It's different than any other investment because it is not tied to any country or government. So it doesn't respond to jobs data. It doesn't respond to GDP. It really doesn't respond to Donald Trump. Sometimes if a Japanese central bank says something specifically about cryptocurrency, or North Korea does, or South Korea, I'm sorry, does something about cryptocurrency, it might have a slight bump on the market. Now, just recently, it's the first time we actually saw cryptocurrencies moving based on geopolitical turmoil. And we saw all the major coins soar last week and become safe havens after the US killed the general in Iraq, the Iranian general, and we were preparing for the response from the Iranians. Now, a safe haven current asset is usually gold, the Japanese yen, or the US dollar. This is where traders run to when they're worried, whether they're worried about inflation, whether they're worried about war, whether they're worried about anything. You'll see this is where they run to for safety. They sell their stocks, they sell their other investments because they don't know what's going to happen, and they move over here to say, well, this is the first time we saw a huge rally in cryptocurrency tied to geopolitical action. And it was quite interesting because they moved textbook perfect. If we had been applying technical analysis, you would have been able to determine exactly what's going to happen. Actually, let me pop up a live chart for you, and I'm going to show you the charts that I work on for analysis every day. Okay, so there we go. We're looking right now at a chart on Ripple. Okay, you can see where I've highlighted the reaction to Iran. This is the day's trading. Now, the minute it started, the asset started to rally, okay, we could see Ripple float straight up from one major support line to the next, to the next, to the next. Everything was predictable. Then after we had the response and the markets eased when Trump and our reigning leader backed off of everything, we saw the markets ease back down. Now Ripple happened to really go all the way back down to its start, and then it recovered somewhat over the past few days. And you can see all of these lines, everything that we see on the chart is technical analysis. But everything was textbook perfect. We can look at Bitcoin, and here we see the same safe haven moves, same time, because all the cryptocurrencies markets rallied. Then they eased back down as the fear left the markets and markets moved to risk off. But in this case, the traders didn't sell it down as far because Bitcoin kept some of its rally, but it came right down to its trend line and bounced off of it at a major resistance line and moved right back up to above its support line and stayed. Now, today, I predicted today's trading about 12 hours ago to stay in this range, and you can see exactly what's happened today. Okay, this is using what we call support and resistance and trend lines. That's it. This is what I use for my trading. And these were all predetermined, but they are all in the field of technical analysis. We can go over and take a look at Ethereum. What do we see? The exact same moves. Push up, I ran, ease back down to this trend line, the sell off, and move back up. And now it's trading between its support and resistance areas today. Now, none of that sounds so complicated, does it? But this is technical analysis and does give you perfect trading decisions. And all you're looking for through your analysis is a filter system to help you filter out strong trades and weak trades. High probability trades is what we're looking to filter, is what we're looking for all the time. Let me just get the PowerPoint back up here. Okay. Now, technical analysts look for patterns on the charts that tend to repeat themselves. They do this to develop their trading edge. The underlying logic here is that since the most price movement is driven by human beings, certain patterns will repeat themselves in the market as human beings tend to be repetitive in their emotion and interaction. Now, lots of people want to do robotic trading. They want to do black box trading. They want to do all of this stuff. But if you stop the thing, and you have to understand all of this price movement is driven by human beings and it's human emotion. Why did we get the price run up during the geopolitical stress? This was human beings that were running to the safety. This was human decisions. And humans tend to repeat their stuff. Now, if you can accept that it's human beings that are affecting the market, not some generic robotic system out there and it's actual human beings making decisions, whether they're individual traders buying a part of a Bitcoin, or they're a big platform, or they're a big hedge fund. It's all a bunch of human beings. And so the market ebbs and flows. Now, I subscribe to this explanation that prices are completely random. They move up, they move down, they move sideways. They're very unpredictable. But there are certain times that price moves in very non-random patterns. And when we can define these patterns, we can make high probability trading decisions. So like you see here, we've got our lines of support and resistance on our chart. We know historically, every time the price of a particular asset reached that point, it had a hard time getting higher or lower. It doesn't mean it can't get higher. It's going to stop there for a minute to hem and haw. So most traders instantly think of a price chart like the above ones when somebody mentions technical analysis. Price charts provide us with an amazing amount of useful data that paints a complete picture of the market's historical and current supply and demand situations. Price charts are also a reflection of all market participants' beliefs about the market and market variables. So by focusing your analysis and trading on the market's price chart, you can streamline your trading and at the same time analyze the result of everything that contributes to the price movement of a market. Now, have you ever heard the adage, history tends to repeat itself? Well, technical analysis is a method of predicting price movements and future market trends by studying charts. One of the major advantages of technical analysis is that experienced analysts can follow many markets and market instruments simultaneously. Now, there are 5 categories in technical analysis because lots of people think everything in technical analysis does involve indicators, MACD, RSI, stochastics, with all these complicated mathematical formulas. That's only one part of it. The main sector starts out with being able to read a chart, looking at a chart and seeing what price is doing. Then we come to understanding trends and trend lines. Well, a trend is no different whether we look at a trend in fashion, a trend in cars, a trend in anything. The trends in music. They are what is coming into fashion or what is coming into vogue at the moment. Then we talk about interpreting price patterns. Patterns are things that repeat themselves. Like price will develop into a triangle. Price might develop into what we call a head and shoulders pattern. And when these patterns start developing, most likely they will continue to develop because over time, these patterns have been isolated. There's only a handful of these patterns, but they've happened over and over and over and over and over again, and they happen basically the same. Okay, so we can put these patterns to work. Okay. And then we have indicators. These are the mathematical formulas. Now, all of these indicators, no matter how complex they are, only have 5 pieces of data they can use: the open, the high, the low, the close, and volume. So they're all different mathematical formulas using those same numbers. And then we have number theory, which gives us like Fibonacci numbers and Gann numbers and waves. Okay. These are certain ways of applying other types of theory to price patterns. So price charts basically just give us a pictorial view of price. Because if I was to say to you, Bitcoin is trading at 84.02 and opened at 81.07 and then jumped to 84.72 and then came to 84.112 and at 1 o'clock was 84.92 and then at 2 o'clock it was 84.97 at 3 o'clock was 79.95. Could you repeat that? Could you tell me what actually happened? Or could you see what was going on in the markets? No, because our brains cannot deal with that. So this is one of the places where a picture is worth 1,000 words. When we put these prices on the chart, whether we're doing bar charts or line charts or candlestick charts, we can then see visually what price is trying to tell us. Now, the other thing about charts and technical analysis is it will help you find an entry point and an exit point, no matter what other type of analysis you're looking at. Okay, I could decide Bitcoin's going to go up today and be completely right about it, but does that tell me what price I should be willing to enter the market? If the market turns against me, or when Bitcoin's reached its maximum today, how would I know that without looking at a chart? So we have line charts, bar charts, and candlestick charts. They all use the same information: the open, the high, the low, and the close. But they help you see in graphic presentations what price is doing, and then we can start to see things like trend lines or trends. See here, we can see price has a trend. Price is trending. Okay, now we can also see some commonality between certain prices. Look at what happened here, and then A year later, what happened with the same price? Here we can actually see a downtrend. We can actually draw a line over the tops of this downtrend to tell us exactly what prices are important. Same thing with this uptrend. We can start to see things with our eye. You may not know what to do with them when you see them, but at least you start to see them. So again, we get to see in a visual format the open, the high, the low, and the close. Now, candlesticks are the most popular out there. Okay, and we'll teach you. We have several classes and teach you how to read candlestick charts. But then we want to go on from just looking at a chart to putting on lines that make sense to us. So like you saw on my chart, I put on what we call support and resistance. These support and resistance are historic levels where price, when it was at this range before, had a problem going higher or getting lower. So imagine these are levels that are the floor and the ceiling of an elevator. The floor is supporting you when you want to go up, and the ceiling is holding you back. And when you want to go to the next floor, you've got to break through that ceiling. That ceiling becomes the floor under your feet, and then you got to move up to the next. Well, as price moves up and down, we have these steps or these ladders or these floors. And if we can identify them and know what they are, we can make valid trading decisions. So there are many ways to find support and resistance. And I use what I call eyeballing. I just go back to look at historical prices on charts. Once we've identified these, we can then start looking for what we call chart patterns. Chart patterns are things like triangles and wedges and pennants and flags. These are patterns that have appeared many, many, many times over history. There's not a great big range of them. There's some weird ones like head and shoulders or teacup and saucer, but when they appear, they tell you something about the market. So we have symmetrical triangles, rising wedges, bearish pennants, increasing, expanding triangles. Okay. These all tell us something about the markets. They're reversal patterns or continuation patterns. To trade these chart patterns, simply place an order beyond the neckline and in the direction of the new trend. Okay. That sounds easy. It's a little bit more complicated than that, but they all get you started in the right way, and they all have formulas that have been tried and tested over many, 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 many years, and they'll help us figure out where to enter the market, where to put our stop loss if we're trading in CFDs, and where our exit price should be or what our target price should be based on the size and shape of that angle. So the most popular, my most favorite, are triangles. Triangles appear often. What happens is there are many different types of triangles. We have ascending, descending, symmetrical, but it's really the story of the traders getting pushed into this apex of the support and resistance line on angles. And as traders get pushed and pushed, the price starts moving less and less. And at some given point, we know the traders have to make a decision. Price is either going to jump up or jump down. We call this a breakout. When it breaks out upward, we call it a break up. When it breaks downward, we call it a breakdown. And we can use that breakout from this pent up demand as price moved in that apex to figure out where we'd want to enter the market and where we'd want to set our take profit points. Then we go over to the complex ones, technical indicators. And remember, indicators, they're the ones that use those complex mathematical formulas, but indicators only indicate. I don't really use them. I teach them. I don't use them. But why use indicators? Indicators serve three broad functions: to alert, to confirm, and to predict. So an indicator can act as an alert to study price action a little more closely. If momentum is waning, it may be a signal to watch for a break of support. Alternatively, if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. But what do we use? Resistance and support. Very important. They come back to trend line, support, and resistance from volume. Give you really everything you need. Indicators can be used to confirm other technical analysis tools. If there's a breakout on a price chart, a corresponding moving average crossover could serve to confirm the breakout. Because what we want to do is we want to apply filters to filter out all the iffy trades so we only end up with high probability trades. According to some investors and traders, indicators can be used to predict the direction of future prices. A technical indicator offers a different perspective from which to analyze the price action. Some, such as moving averages, are derived from simple formulas and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas. But remember, indicators indicate. And even though it may be obvious when an indicator generates buy and sell signals, the signals should be taken in context with other technical analysis tools. Many traders swear by them to help with their timing of their trades and to alert them of trends. These technical indicators measure the direction and the strength of a trend by comparing price to an established baseline. We have things like moving average convergence and divergence, known as MACD, parabolic stop and reverses. Okay, we have momentum indicators, we have volatility indicators, we have volume indicators. Okay, oscillators are the most reliable in periods when there's no clear trend in the market. Prices are moving sideways in a narrow range between a particular support and resistance level. But again, support and resistance level. In such an environment, oscillators can yield quick, precise buy and sell signals. I believe as oscillators and indicators as interpreters. When we can't understand what the price action and what the price on the chart is trying to tell us, we can go to these indicators or to these interpreters to see if they can help interpret it a little bit better for us. So technical analysts consider the market to be 80% psychological and 20% logical. Fundamental analysts consider the market to be 20% psychological and 80% logical. Psychological or logical may be open for debate, but there is no questioning the current price of a security. After all, it is available for all to see and nobody to doubt its legitimacy. The price set by the market reflects the sum knowledge of all the participants, and we are not dealing with lightweights here. These participants have considered everything under the sun is settled on a price to buy or sell. These are the forces of supply and demand at work. By examining price action to determine which force is prevailing, technical analysts focus on the bottom line. So even though there are some universal principles and rules that can be applied, it must be remembered that technical analysis is more of an art form than a science. As an art form, it is subject to interpretation. However, it is also flexible in its approach, and each investor should use only that which suits his or her style. Developing a style takes time, effort, and dedication, but the rewards can be significant. So it tells us what is the price, where it has been, and where it is going. So thank you very much for joining us tonight. Thank you for being part of the CoinLib family, and we'll talk to you again real soon. Good night.